Right now, we can clearly see that there are two gold markets on this planet, one in the West and one in the East. The West is driven by monetary policy. It's basically all Fed all the time. Gold is a passive, uh, really a dead asset. Thank you, Berkshire Hathaway, for that. Gold uh, earns no interest, so gold falls and when real rates rise. It's always been that way, hasn't it? Bonds are better than gold when rates fall because the bond price rises. Deficits are good for stocks because it's more liquidity. Debt levels are manageable. Jay Powell says so. They're a non-issue, and actually they were a non-issue back when we had zero interest rate policy. Not so now. The exceptional U.S. economy will always attract capital. Well, it better because it doesn't have any of its own anymore. And the Fed is cutting rates to avoid a hard landing, which seems odd in an economy that's growing at about 2.5% a year. So that's how the West sees things, and that's not an incentive to buy gold stocks. And of course, gold stocks are a Western phenomenon. So we, in fact, have gold stocks trading for less than half of what they were trading for in 2011, when on a monthly closing basis, gold is now $700 an ounce higher. So not a good market for gold stock. Now, looking to the east, it's all about fiscal policy and fiscal risk. First of all, gold is an active asset that cycles just like the dollar, especially in the oil market and natural gas now as well. Gold does not depreciate like the dollar. Gold is no one's liability, can't be sanctioned. Deficits are inflationary, everybody knows it. Debt is destabilizing. Capital is probably in the process of starting to leave the US due to a negative investment process whereby they, that is, Americans own put it the other way around. Foreigners own $22.5 trillion worth of US assets, more than US investors own of the rest of the world, which is making US highly vulnerable. And the Fed is cutting rates due to fiscal pressures. That seems to be clear to everyone outside the United States, at least. Next slide. So let's look at the fiscal situation. US federal government spending is on the rise again. This chart is in real constant dollars. So we had, of course, the spikes in spending, which were due to the pandemic, and now it's on the rise again for really no good reason. Next slide. And as a result, deficits are also rising, despite a growing economy and very low unemployment by historic standards. This shouldn't be happening. Next slide, please. And the result of that is that federal interest expense is now 33% of annual tax receipts and rising rapidly. There are about $15.5 trillion worth of US federal debt that will roll over the next 3 years. The average interest rate for that debt is 2.3% currently. It's not going to be 2.3% when it rolls. It's going to be higher. So this number is going to continue to rise. Next slide. This is how foreign investor looks at the dollar. They look at it versus gold. Americans tend to think in terms of the Dixie, the relationship between the dollar and the euro, the yuan, and the yen. But that doesn't work when you're outside the United States. This is what foreign investors are looking at, and the result is they want more gold. Next slide. Foreign investors are avoiding US sovereign debt. If you look at total foreign holdings of the T-bills, they've gone from just under 50% to just over 20%. If you look at coupon stuff, duration, it's gone from over 60% to just a little over 30%. So foreign investors are backing away from US sovereign debt. That's going to be a big problem coming up. Next slide. And another reason for doing that is that there's a risk of sanctions. And you can see, first of all, on the left, a list of the countries that are currently subject to sanctions. And on the right, a graph that shows you the increase in those sanctions on a GDP weighted basis. There are lots of people now and countries and companies subject to sanctions, which is another reason not to be holding a lot of dollars. Next slide, please. And so one result of that is that central banks are increasing their holdings of gold. They are rising as a percentage of total reserves. That's the red line, whereas holdings in U.S. Treasuries are falling. That's the black line. And they're going to meet here at some point. Next slide. So the World Gold Council went out and surveyed the central banks, the emerging market central banks in particular, that have been buying gold, and they gave their reasons for why they're doing it: selling dollars, buying gold. And the reasons in order were to hedge the dollar in terms of inflation, then to hedge default risk. Believe it or not, nobody in the US talks about it. People outside the US do, and to avoid sanctions, understandable. Next slide, please. So the result net is that physical gold is increasingly headed to Asia. The Swiss have the 4 largest gold refiners on the planet, and where they are sending gold is an important tell, and increasingly it's going to India, China, Gulf Coast. These are the places where gold is attracting a premium and is moving toward, not so much to the West. Next slide. So we look at the West. Western institutions have almost no exposure to gold. And this, more than any other reason, is why gold stocks have been struggling. And in fact, 71% of asset advisors have essentially no exposure to gold, which is a big number that has not been getting much better yet. Next slide. Here's a fun one. This is from McClellan, very well-known, long-standing advisor to stocks and asset managers. They see deficits as bullish for stocks, and in fact, the figures do not lie. So when you talk to Western investors about the fact that deficits may be a problem, what they see is a higher S&P, more liquidity, so not concerned. Next slide, please. And here we go into rate cutting. There were actually 26 rate cuts in September alone. Amazing turn of events. We're almost at historic levels. This, of course, is good for bonds, and bond buying proves it. Of course, once the rates get low enough, then it'll be an incentive to buy gold, but not yet. So next slide, please. So here's an interesting slide. Apparently, the quarter we just left was the 4th best quarter for buying bonds this century. And if you look at Bloomberg, who have an index on everything, they have an index on the 60-40. That is the prevalence of people investing or managing their portfolios to be 60% assets and 40% bonds. And it's never been more popular. So the amount of money that has crowded into bonds over the last year has been extraordinary. All mostly the last 3 or 4 months in anticipation of Fed rate cuts. Next slide. And here's where we see the selling. In fact, we've seen significant net selling by Western investors through physical gold ETFs, which reached a peak of over 3,000 metric tons in 2020, and then started an abrupt turn down, and along with the gold price, which is the exact relationship you would expect normally to see, which was an anticipation of real interest rates rising. That is, the Fed raising rates. And that continued with wild abandon, selling something like 1,600 metric tons, a huge amount of gold, until Ukraine. And that was the final straw for foreign central banks, particularly emerging market ones. And the game was on, and additional amount of gold made available by Western investors through ETFs was more than taken up by central banks and private investors in China, India, and elsewhere. Okay. Oh, and by the way, you can see at the bottom of that black line, the ETF gold holdings, that there's a little turn upward. And yes, there is a turn upward. We've stopped seeing the wholesale selling of gold from the ETFs. And in fact, they have net added $3 billion worth of gold purchases in August, but that's a tiny amount compared to what was sold. There is still not a lot of new money coming into the gold market from the West. Next slide. Here's a fun slide. Every one of those blue vertical lines is another $1 trillion in US debt. And you can see they come thick and fast once we get into the pandemic and the response to it. And not surprisingly, as you get more blue lines, you get more lift in the gold price, which appears in the red line above. Now we're seeing an additional $1 trillion of debt approximately every 100 days. This is not sustainable. Next slide. And this is probably the most scary graph of today's presentation. We now have a US economy that relies entirely on foreign net savings. US is right across the board a net dissaver. In other words, is not able to generate its own capital at all. It is dependent on foreign capital. And that's particularly relevant now when both political parties, and who knows who's going to win, and I'm not going to get into that, but both parties are substantially in favor of reshoring manufacturing, which will take an enormous amount of capital because the US can't even rebuild its military anymore without beginning to attract more manufacturing capability onshore. And this is occurring, this need for reshoring capital, when it appears that foreign capital is beginning to leave the US. How do we know this? Well, little things like the Chinese massive reliquefaction of their economy last week. What happened? Well, you should have seen a collapse in yuan. It went up. Why? Because Chinese capital was being taken out of the US and back repatriated to China. So, and we're also seeing somewhat similar moves, smaller scale, from Japan. So where is the capital going to come from? Well, probably the Fed. There's really no other source. As you can have seen in the presentation to date, just not getting the foreign interest in investing in the US that we've been used to. Next slide, please. And liquidity is extremely loose. You couldn't have it be much looser. This is the Fed's own data. What's interesting here is that every time the financial conditions are not loose, every time they tighten, you get a recession. The U.S. cannot afford a recession. Currently, the U.S. is running a deficit of about 7.5% of GDP. If we have a recession in the U.S., we're going to see that number increase to 11, 12, 13%. It's very easy to project. So those conditions are going to have to remain. And that's another reason why you probably get better GDP for performance in the US than elsewhere. But you're also going to see increasing evidence again of inflation. Inflation has not been cured if you have this kind of extremely loose financial conditions. Next slide. So US federal debt to GDP is out of control. It's over 120%. You know, this was okay. It was manageable with zero interest rates, but not so much when the interest rates are real and currently still above 4.5%. So the debt has to be inflated away. And it's not as if the US is naive or innocent of knowing how to deal with this, because next slide, please. This is what was done after World War II when US real rates fell to minus 14% on a lower debt to GDP ratio than we have now. But that's going to be necessary to reduce the debt to GDP ratio. And as you can see on the right, one of the main methods was yield curve control, where the Fed simply pinned the 10-year yield at 2.5%. So as we move into this kind of reality where the fiscal becomes more important than the monetary, and the debt and fiscal policy related to it become more important than interest rates, we're going to see the West invade the gold market like there's no tomorrow, because in many respects, for the dollar at least, there may not be. And as a result, we will get the next move in the gold price, I'm predicting, to take us well past 3,000. East is not going to stop buying because they understand already what's happening, but the West will join. Thank you.